If you're close to retirement, you've probably heard two completely opposite pieces of advice. Play it safe, move everything to cash or bonds, or if you don't stay aggressive, you're going to run out of money. But both of those could be wrong for you. The better question isn't how much risk can I stomach or how much risk gets me the highest return. It might just be how much risk do I actually need to reach my goals? And how much risk is going to keep me up at night unnecessarily. Today in the Retirement Income Lab, we're going to put retirement risk under the microscope and look at the three numbers that really matter. I'm Patrick Huey. I'm a certified financial planning practitioner, and let's get to work in the lab.
You're entering the Retirement Income Lab with certified financial planning practitioner Patrick Huey, where your questions about retiring and staying retired get answered. No hype, no stock tips, just data, discipline, and the right decisions to help you make retirement a reality. You ready? Good. Let's get to work in the lab. Here's your host, Patrick Huey.
Welcome back to the Retirement Income Lab, where high-saving professionals turn portfolios into paychecks they can actually live on. If you're within 5 years of retirement or just getting into it, this series is for you. We stress test real-world retirement income decisions so you don't have to test them out there in the real world on your own portfolio. Now, if you watch this and think, hey, this sounds like my situation, this is something I'm interested in, you can always schedule a retirement income lab assessment with me at victoryindependentplanning.com/contact. And I'll explain more about that at the end of the show. For now, let's talk about risk, the kind you need and the kind that just causes heartburn. So when markets are choppy, a lot of people's first instinct is relatively simple. Just get me off this roller coaster. I want something safe. It's fight or flight, and your brain chooses flight. And guess what? I understand that. No one enjoys watching their account balance swing around, especially when you're close or just got into retirement. But here's the catch. Too much risk can blow up a good plan in a bad market, and too little risk can quietly starve your plan over 20 or 30 years in retirement. If you move everything to cash or short-term bonds at 60, you might feel calmer, at least for a while. But if inflation keeps grinding away and your portfolio barely grows, you may end up safe today and short of money in your 80s. So the goal in retirement is not zero risk. The goal is aligned risk. And that starts with understanding three different things: your risk preference, your risk capacity, and the actual risk in your portfolio. Now, these three ideas are borrowed from modern risk alignment tools like Tiffin Wealth's framework, which we use in my practice, and they're very helpful for retirees. First, let's talk about risk preference. That's how much risk you're willing to take. It's emotional. It's about your comfort level, and it can move around quite a bit. For instance, when markets are high, risk preference tends to be higher. When markets dive, risk preference tends to go lower. When markets are calm and everything's going up, most people feel aggressive or more aggressive than they usually would. But when markets are ugly, that very same person, that same investor, that same retiree might suddenly feel pretty darn conservative. There's nothing wrong with having feelings about money. It's normal, it's natural. But if you let your feelings set your portfolio, you might end up buying high and selling low. Buying when things are great, selling when you panic and the market dives. And last time I checked, that is not the preferred way, or any way at all, to make money. Second, let's talk about your risk capacity. That's how much risk you can afford to take based on the facts of your life, your age, your health, how much you've saved, whether you have a pension or just your portfolio, what you actually spend, and whether anyone's depending on you financially. Think of risk capacity as your financial runway. If you have a long runway, you can afford a bumpier ride. But if your runway is short, you're retiring soon, your spending is high, and there's not much margin for error, you may not be able to take big hits, even if you think you can. Third is portfolio risk. That's the actual risk that your investments are taking on your behalf. It's your mix of stocks, bonds, cash, and other assets. It's how concentrated or diversified you are. And it's how much your portfolio might go up or down in a typical year or in a bad year. Most retirees have never seen these three numbers side by side. They know how they feel, and they have a rough idea of what they own. But they've never asked, does what I own fit both what I can emotionally handle and what I can financially afford? That is what real risk alignment is about. So let me bring this to life with a simple case. We're going to call our couple David and Karen. We'll say both are 63. They've saved $1.8 million total. They want to spend about $95,000 a year after tax in retirement. They have no pension, but they have two Social Security checks coming later, some point in retirement. And they're hoping to retire at age 65. Here's what three risk numbers will look like for them. First, risk preference. Now, David has always loved the market. He's the I wish I'd bought more during the last downturn type of guy. He's the one who's buying the dips. Karen, however, still remembers 2008. She still remembers 2020. And she hates seeing big losses. Red numbers drive her crazy. So she's naturally more cautious. On a questionnaire, a simple risk tolerance questionnaire, they'll come out moderate overall when you combine them together, maybe even moderately aggressive, but we'll call it moderate today. Not adrenaline junkies by any sense of the imagination, but they're not hiding cash in the mattress either. Now, let's look at risk capacity. On the facts, at 63, they're close to retirement, but they're not there yet. With $1.8 million in moderate spending, they do have a decent cushion. And if they retire at 65, they're likely facing 25 to 30 years in retirement. They can afford some market volatility, but not repeated 30 to 40% hits with no plan. So their true capacity is moderate to moderately high. As long as the portfolio is diversified, they have a plan for downturns, and they don't panic sell at the wrong times. So, moderate on the risk preference, moderately high on the risk capacity. Now, what about their portfolio risk? Well, we look at what they actually own here, and it turns out they're 85% in stocks, 15% in bonds and cash. And a big chunk of the stock side is in a single company that David works for. Based on history, this portfolio might swing plus or minus 20 to 25% in any year, and even deeper in a bad bear market. So that level of portfolio risk is more like aggressive growth, and it's not moderate or moderately aggressive. So what's going on here, right? The risk preference says moderate. The risk capacity says moderately aggressive, but the portfolio is set to full speed ahead. Well, that misalignment is what keeps people up at night, whether they know it or not. They feel it, and their subconscious tells them that something just is not right. They might feel fine today, But the first serious correction in their 60s or their 70s just might push them into panic mode. Now let's ask the core question. How much risk do David and Karen actually need? Well, when we run their numbers through our planning tools, we might see something like this. If they earn a long-term return of, say, 5 to 6% and stick to a safe withdrawal rate, they have a high probability of success. If they earn 7 to 8%, the probability ticks up. But now they're living with a lot more short-term volatility. And if they earn 3 to 4%, they start to struggle late in retirement unless they cut spending. In other words, they don't necessarily need to swing for the fences to make their plan work. But they also can't afford to hide entirely in cash and bonds. So the right question for them isn't how can we get the highest possible return? It's what mix of investments gives us a good chance of funding our plan without taking more risk than we can handle either emotionally or financially. Now, maybe in their case, that's 60% in broad mix of stocks and 40% in bonds and cash, and much less concentration in any single company. And that portfolio might still have years where it's down 10, 12, 15%, but it's much less likely to be down 30 or 40% at the exact wrong time. Is that perfect? No. And no plan is, but it's aligned with their goals, with their need for growth, and with their actual ability to ride out downturns. So, how do you know how much risk will keep you up at night? Well, here's a few questions you can ask yourself. In 2020, 2018, or 2008, how did you react? How about last year when stocks tanked on tariff fears? Did you stay the course? Or did you feel physically sick looking at your accounts? Or did you completely avoid looking at your accounts altogether? If your portfolio dropped 20% next year, what would you do? Would you stick with your plan? Would you be calling your advisor or logging in to sell things at the bottom? Would you lose sleep at night? How much flexibility do you have in your spending? If markets are down, can you tighten your belt for a year or two? Or is your lifestyle very rigid? How important is it to you to leave money to kids, grandkids, or charity? The more legacy focused you are, the more you may need growth, which may mean living with a little bit more volatility. The point is never to eliminate all risk. It's not possible. The point is to set your portfolio risk inside of a band where you're taking enough risk to grow and protect your purchasing power, but not so much that a normal bear market pushes you into actions that you may regret. So, how much risk do you actually need in retirement? Well, here's the short answer. It's enough to give you a high probability of funding your spending plan with enough growth to fight inflation, but not so much that you're constantly on the edge of panic. To get there, you need to see the three numbers together: your risk preference, how you feel, your risk capacity, how much you can financially afford, and your portfolio risk, what you're actually doing now. If those three are aligned, you're far more likely to be able to stay in your seat when the markets get rough. And that means an increased probability of success, no matter what your risk tolerance. If you're out of alignment, well, then you either take more risk than you realize, or you take so little risk that you quietly run out of money over your retirement period. Neither of those is a recipe for a good night's sleep. Now, if you're watching this and thinking, I have no idea how much risk I'm actually taking or whether it matches what I need, that's exactly what we work on in the Retirement Income Lab. I'm a fiduciary, certified financial planning practitioner, and I'm the owner of Victory Independent Planning. I work with high saving professionals all over the country who are within about 5 years of retirement or have recently retired. And in the assessment, we'll clarify your goals and your spending needs. We'll measure your risk preference and your risk capacity, and we'll analyze your current portfolio risk. And then we'll talk about how different mixes of investments affect your retirement income and your ability to sleep at night. If you'd like that second opinion on how much risk you actually need in retirement, go to victoryindependentplanning.com/contact and schedule a short call with me. The link is also in the show notes for this episode. If you found this helpful, please subscribe to the Retirement Income Lab. Hit the like button. It helps more people see these episodes and get the help they need for retirement. Now, in our next experiment, we're going to tackle a slightly spicier topic: why your advisor might be the biggest risk in your retirement plan, and what you can do if your advisor, frankly, well, sucks. You don't want to miss that one. Thanks for watching. I'll see you next time in the lab.
This has been the Retirement Income Lab with certified financial planning practitioner, Patrick Huey. To stress test your own retirement income plan, visit victoryindependentplanning.com/contact and schedule your introductory call today.